Good morning, OPG and friends. It's Joe Signorelli with OPG Advisors. We're getting ready for our 11 a.m. webinar with Tannenbaum, Helpern, and CohnReznick. Just hold on for about 2 minutes. I'm going to put you on mute. We have about a quarter of the population logged in. I want to give everybody a few minutes before we get started. So just hang tight, and we will be right back. Okay, everyone. We're getting a good number of people coming in, so I think we can get started on time. A few house cleaning items for everybody. You can submit questions directly through the questions box in the GoToWebinar app. I'll be monitoring it, and I'll throw them out to the group and to the presenters if I see one come in. Choose not to unmute everybody. It gets a little complicated, so this is easier. You can also send chats to us or to the group during the webinar if you need to. We're going to try and keep it to around 40 minutes, give or take, today, and recording it, so I'll also distribute it out to the wider group of people who aren't able to make it today, or if you want to re-listen to it, so that you have it. Great. So today we're going to talk about some recent developments in the employment tax exemption for LPs, and do an update on the PTET rules that I know drives everybody crazy, or at least drives me crazy. And we have a couple of great friends of the group and experts here to talk about it. Robert Richard, I hope I said it right, from CohnReznick. He's a partner in their financial services and hedge funds tax group. And then we have a very good friend, Michelle Etry from Tannenbaum, Helpern, who has done a few webinars with us over time and spoke at our event, and love having her back. So we appreciate a few minutes. I'm going to throw it to you guys. And like I said, if I see any questions come in, I'll jump in. And any problems, give me a shout. It's all yours.
Great. Thanks, Joe. So today we're going to talk. 1 second. Today we're going to give an update, as Joe mentioned, on a recent tax court opinion that has implications for the application of the self-employment tax to income allocated to partners of investment management firms that are structured as limited partnerships, and the current state of the state pass-through entity tax programs. So just to give a little background on self-employment tax, Section 1401A of the tax code imposes self-employment tax on self-employment income of individuals. This tax is similar to the employment taxes payable by employees under the FICA, the Federal Insurance Contributions Act, which includes Social Security taxes for self-employment income of 12.4%, up to an annual cap around 160,000 this year, and 3.8% Medicare tax, which is 2.9% on all income and 0.9% over income of levels of 125,000 and more. However, there's an exception in the code under Section 1202A13, which provides an exclusion from self-employment taxes for the distributive share of any item of income or loss of a limited partner, quote, as such. And this is a so-called limited partner exception, does not imply to guarantee payments paid to a limited partner for services actually rendered to a partnership. It's specifically designated to apply to distributive shares of items of income or loss of limited partners other than guaranteed payments. And neither the code nor the regulations define limited partner for purposes of this exclusion. And so managers of private equity funds and hedge funds are routinely structured as limited partnerships, basically to exclude their management fee and incentive fee income from self-employment taxes, relying on this section of the code. In the typical structure for an investment fund manager, the partners are paid guaranteed payments, usually at a market rate or base salary for their services, and that base salary guarantee payment is subject to the self-employment tax. and they take the position that any remaining amounts that they are allocated above those guarantee payments are excluded as an allocation of limited partner profits and excluded from self-employment tax. Now, the IRS has not issued any guidance on this exception since 1997. In 1997, proposed regulations were issued that would have excluded from the exception limited partners of a partnership that work 500 hours or more per year for the partnership. Now, these regulations were never finalized, and Congress imposed a one-year moratorium on the finalization of these regulations, but they never ended up being passed or adopted. So, take it to 2011. There was a tax court case involving a limited liability partnership in which the IRS prevailed in its argument that limited partners of the limited liability partnership, who were lawyers of a law firm, were not limited partners within the meaning of the exclusion in 1402(a)(13) because they actively participated in the partnership's business, performing services, and therefore were subject to self-employment taxes on all of their income allocated to them by the limited liability partnership. However, this holding in 2011 has not been definitive guidance for limited partnerships, since it was limited just to LLPs, entities structured as LLPs. So basically, since then, partnerships have been created in the investment fund space and to utilize this exception in the code. But now the IRS in recent years has started an audit campaign which focused on claims that are being made by limited partners of partnerships in the financial services space that for the application of the 1402(a)(13) exception. When announcing this audit campaign, the IRS noted that, in its view, some individuals were improperly claiming the limited partner status to exclude their income from self-employment taxes. Now, there are currently 3 pending tax court cases involving this exclusion that may provide some long sought after guidance related to the application of the self-employment tax to limited partner income from partnerships. In addition to the case we'll be discussing today, Sorobon Capital Partners, there are 2 other cases being litigated on the topic are Denham Capital Management and Point72 Asset Management LP. Now, the most recent ruling that it was issued, an opinion from the tax court issued this past November 28, 2023, was a case involving Sorobon Capital Partners, which is an investment firm based in New York that's organized as a Delaware limited partnership and classified as a limited partnership for federal income tax purposes. Sorobon had 3 limited partners and a 1% general partner. Each partner received a guarantee payment for its services and paid the 3.8% tax on the guarantee payment. And during the tax years at issue, Sorobon had reported that the guarantee payments made to the limited partners were net earnings from self-employment on the K1s, and they pay their tax on that income. But they excluded their distributive share of ordinary business income under the theory that such income fell within the scope of the 1402(a)(13) limited partner exception. Now, after a tax audit, the IRS disallowed the exclusion and adjusted Sorobon's net self-employment tax earnings to include the distributive share of earnings of ordinary business income allocated to limited partners. According to the IRS, the individuals were limited partners in, quote, in name only, and therefore should not be able to rely on the exclusion. The Sorobon challenged the IRS adjustment in the tax court, arguing in their motion for summary judgment that as a matter of law, limited partners of state law limited partnerships were not subject to the self-employment tax on their distributive shares of earnings. And the tax court rejected Sorobon's argument, instead holding that a functional analysis test is required to determine whether some individual is a limited partner, quote, as such, for purposes of section 1402(a)(13). The tax court looked at the plain meaning of the term limited partner and the inclusion of the phrase as such in the code and determined that the statute was intended to apply really to passive investors in a limited partnership, as opposed to limited partners who were actively participating in the operations of the limited partnership and were really limited partners in name only. The functional analysis test really focuses on the purpose and role of a partner, particularly the extent to which the partner is performing services for the limited partnership. And I will pass this over to Rob to see where we go from here.
Thanks, Michelle. I think, like, one important thing to point out about the Sorbonne case is it's just a ruling and summary judgment. So the tax court has not made a decision that, these folks are indeed, subject to self-employment tax, just that, their argument that, to dismiss the case on the basis that they're a state law limited partner, wasn't, enough. Unfortunately, they really haven't, provided guidance as to what the functional analysis test is. So that leaves like a little bit of a question mark as to like what factors is the court going to look at in ultimately deciding whether or not, these people are subject to self-employment tax. Back in 1997, the IRS did, have proposed regulations on this topic that were never finalized. And, they kind of looked at three factors to determine, under a functional analysis test, whether or not somebody would be subject to self-employment tax. When you look at the three factors, one was, were they personally liable for partnership death because of its partner status? I think that's probably one that you could easily, get around, especially if there's a GP of a limited partnership that would be the one with the liability. However, the other two would be harder. Could they contract on behalf of the partnerships, or have they participated in the activities of the partnerships for more than 500 hours in a year? So in the case where you have, a management company with 3 managers, and this is their primary, job is running this, hedge fund business and managing this business, it would really be hard to circumvent, this type of functional analysis test, assuming the tax court goes in a similar direction to what those proposed regulations were. Even though, like, as I mentioned before, that this was not a ruling saying that they're subject to self-employment tax, this case was a significant victory for the IRS, and the fact that the court has rejected the per se eligibility of 1402A13. So, the argument is saying, hey, because we're a state law limited partner, we're just not subject to self-employment tax. They now have guidance to, to combat that. So it's, definitely going to be more difficult to, for people to continue with this filing position, until further guidance comes out.
Hey, Rob, it's Joe. Let me try and paraphrase this question that came through. So let's just look at a typical hedge fund. Limited partnership does the investing, got a management company it pays the fee to. There's a few owners in the management company. It's got a GP that's invested in the LP, and everybody receives the carry within there. So most people are creating a management company these days, I think, as an LLC function, and same as the GP entity. Is that still the best course of action with all of this? And what, just considering what they're thinking here in this court case, like what's the best way from scratch that you think is smart to set this up right now?
So typically, if you look at a typical fund structure, you would have two, especially if you're in New York City, you would have two, management entities. You would have a GP entity, which is the entity with the carried interest entitlement that I typically see structured as a limited liability company. And that separate GP is typically done for state purposes because, the carried interest, assuming, it's regular capital gain type income, would not be subject to a New York City unincorporated business tax, whereas management fees are. The management companies, recently people have been structuring them as limited partnerships, with an LLC being the general partner of the limited partnership management company. And the reason for that, as opposed to structuring the management company as a LLC, was to take advantage of this 1402A13 exception. Kind of in my view, this, we don't know where this is ultimately going to land in the outcome of these cases. I think it would be prudent to continue structuring your management company as a limited partnership, as I don't really see a downside, to that structure other than, perhaps an additional tax return for the GP of the management company. So a little bit of, additional compliance work. Michelle, I don't know if you kind of have similar thoughts.
Yes, I agree. Until this is all kind of works itself out, we are continuing to form management companies as limited partnerships. However, there are some clients who are more risk averse and are just going forward with LLCs, given where we are, given the audit risk that it poses. We are seeing some clients avoid that risk and are starting as LLCs, but for years, we were doing management companies as limited partnerships for this purpose.
And inside the
Right.
LP, inside the LP entity, everybody's what structure? Limited partner, is it general partner, LLC? How are you structuring it inside of it?
Yes, so as Rob mentioned, the general partner is always structured as an LLC. And usually the general partner receives about 1%, well, up to 5%, but usually just 1% interest. And then the limited partners share in the rest. And with the limited partners getting a guarantee payment for their services, usually, whatever given their title, whatever the market, rate is for their title for a base salary,
Yep.
Effectively for their guarantee payment, and then they share the rest according to their percentage ownership.
Right. So I think this kind of begs the question, like, what do we do now? This ruling just came out in November. We're now in our busy season. We're starting to, work on filing these tax returns. And, for, managers who have historically been excluding self-employment tax, where does this leave us? And I guess there's a few options we can kind of go through. So, for 2023, my advice to people has been to file extension, pay the tax, assuming you're subject to self-employment tax, and see if anything develops prior to the filing deadline, which would be in September of 2024. So there's some more time. And then if there's still no further clarity by that point in time, you have to consider the following, three options. One would be you can continue with your current filing position and see what happens. With that one, I'd say that's probably on the aggressive side, given this recent guidance. So you're going to have discussions with your tax advisor as to how they feel about that. The industry is still absorbing this, so I'm not sure if you're going to find people are going to be uncomfortable signing, tax returns with that filing position, or they might, suggest that you file the tax return with a disclosure. While disclosures, people are usually adverse to disclosures because they feel it's like a kind of an audit red flag. I'm putting a disclosure of an uncertain tax position on my return. However, it does kind of protect you against, the IRS assessing penalties if you disclose the position, compared to not disclosing the position. So that's certainly something that, you need to think about for two reasons. One would be penalty protection, and two would be, your preparer may not be willing to sign the return otherwise. The second option would just be to pay the self-employment tax, and if the case is ultimately decided in a way that's favorable to the taxpayer, possibly amending returns to get a refund if you really feel it wasn't ultimately subject to self-employment tax. The third option that people could consider would be using a S corporation, which I don't really think is going to happen. So S corporations is another way that people could work around self-employment tax, where with an S corporation, you would have to pay yourself a reasonable salary. That would be W-2 salary, and it's pretty well established law that any profits above that W-2 salary are not subject to the self-employment tax. There's always the risk of argument as to what is a reasonable salary, which is like a way that the IRS could try to attack it. There's also other significant downsides of an S corporation as opposed to partnership, which is the reason the industry has kind of gotten away from them. One is, you really can't have special allocations at profits interest partners like you do with a partnership. It has to be like, one class of stock and a very pro rata simple allocation. And then also, like for New York City purposes, they're considered a C corporation. So you might, in fact, be incurring additional city tax with that structure. So there's a lot of like variables you need to weigh to see if an S corporation would be right for you. Probably the simplest way you could do it if you wanted to do an S corporation would be to keep the management company in a partnership structure and have each, partner of the management company have its own S corporation, which would kind of avoid the issue with the, special allocations and lack of flexibility. The last point I would say for 475F funds or trader funds, this is something you want to think about whether or not you're being compensated as a fee or an allocation of profits interest. So this is on the carry piece, because some of them may have been structured as paying, an incentive fee as opposed to an allocation in the past, where if you'd taken the position as a limited partnership, the fee would not be subject to self-employment tax, whereas the carried interest allocation would be subject to a 3.8% net investment income tax. However, given this change, and especially if you're in the city, it probably would be advantageous to go with an allocation, because even though the allocation is subject to net investment income tax, the carried interest allocation would not be subject to a 4% New York City unincorporated business tax. So there's a little bit of savings there. I think that, is kind of all that we have on the Sorbonne case and the self-employment tax issue. Are there any, further questions? If not, we'll move on to the pass-through entity tax discussion.
Yes, and we're happy to take questions at the end of the presentation as well on this
I
topic.
don't see any in the queue. We look good.
Okay, all right, great. So we'll move on and give a little bit of background on the pass-through entity tax that I know has been driving accountants like Robert crazy for the last few years. Very complicated, but it is, as we'll discuss, very meaningful ability for individuals located in high tax jurisdictions like New York City. So as we all know, in 2017, the Tax Cuts and Jobs Act imposed a $10,000 limitation on an individual's ability to deduct state and local taxes. This applies for the tax years 2018 to 2025, and yet to be seen whether that will be extended when that deadline approaches rapidly. I can't believe rapidly next year. In response, many states, with Connecticut being the first, enacted laws allowing pass-through entities, such as partnerships, LLCs, and S corporations, to make an election to pay state and local tax at the entity level. This election effectively shifts the state tax liability from the individual partner to the pass-through entity itself, generating a state tax expense deduction at the entity level that reduces each individual owner's distributive share of taxable income for federal income tax purposes. So this is effectively, it's like the New York City unincorporated business income tax that's payable at the entity level for LLCs and partnerships. Now all state and local taxes now can be paid for the states that have these programs are basically paid at the entity level. And this effectively allows a federal tax deduction for state and local taxes, unlimited for deduction for state and local taxes payable on income generated by pass-through entities.
And hey, Michelle, I think like an interesting thing to point out, with the unlimited deduction is, some people say to me like, hey, in 2025, if this 10,000 cap limits, do you think there's going to be no more pass-through entity tax? And I think the answer to that is no, it's still going to exist. And the reason for that is prior to the Tax Cuts and Jobs Act, even though there was no limit on the deductibility of state and local taxes, when it got down to the individual level, it would be subject to AMT and a P's limitation and, a whole bunch of limitations. And the practical answer to that was people in places like New York who made over $150,000 or $200,000 a year wasn't getting a state tax deduction anyway. So,
Right.
The regime kind of went from you're probably not getting a deduction to you're definitely not getting, a deduction. So if you look at pass-through entity tax, an above the line deduction, you're getting 100% of it with no limitation like AMT or anything like that. Even if you lift that $10,000 cap, I think that, people are still going to want to do this.
Right. That's definitely true. Basically in 2020, the IRS blessed these structures in a surprising ruling or notice, 2020-75, where the IRS indicated that a pass-through entity can deduct state income taxes paid by the entity pursuant to a state pass-through entity election, as long as the state income tax is directly imposed on and as a tax liability of the pass-through entity itself. In this notice, the IRS found that partners and partnerships who make basically the PTET, the pass-through entity tax elections at the state levels, are not subject to state and local tax deduction limitations for partners and shareholders who itemize deductions. Through this notice, the IRS announced forthcoming regulations that will clarify the IRS's position on these programs, but those regulations have not yet been issued. And unfortunately, guidance is needed on this topic to alleviate a lot of the complexities, but nothing since that notice has been issued. But since the issuance of the notice, a number of states, including New York, have enacted their own pass-through entity tax election statutes that Rob will discuss in more detail in a moment. But first, we wanted to just give you an example to show you how beneficial these elections can be for individuals who reside in these states, these high tax jurisdiction states. So we'll give you an example. Myself, Michelle, a resident of New York, allocated a great deal of income last year, just $1 million of income in 2023, and the partnership elected this PTET election, and assuming a 10% tax rate for simpleness, the entity paid $100,000 of New York State tax on the income. Now, I will pick up $1 million of income on my New York State personal tax return and will be entitled to a $100,000 credit against my personal New York State tax liability. By utilizing the pass-through entity program, the partnership will take a federal deduction of the $100,000 state tax paid, resulting in only $900,000 of income allocated to Michelle for federal tax purposes. Assuming a federal tax rate of 37%, this deduction will reduce my tax liability by $37,000. In addition, I'll also benefit by reduced self-employment tax, income tax, because this income, my self-employment, that 3.9% Medicare tax will not apply to that $100,000 that deduction. So as you can see, there is a pretty large benefit for, and when you multiply this by hundreds of partners in a partnership, this really can be a lucrative program for partnerships to elect into.
Right. I think when you look at this example, like on $1 million of income, you're saving $37,000 of tax by making this election. It's meaningful, and granted, there is a lot of like kind of administrative complexity, some additional cost you're going to have associated with dealing with the admin to make PTET elections. It's clearly worth it when assuming you're making a significant amount of income for the savings.
Right.
Just like a little bit of a personal story with PTET, which is interesting, is sometimes the calculations get really bizarre. So if you kind of look at CohnReznick, we have offices in 20 plus states. So I get 20 state K1s, and before PTET or even with PTET, I'm a New York resident, but I actually pay very little New York State income tax because let's say 70% of my income is apportioned to other states that the firm has offices in. That's just the way that the rules work. So the way it works when I do my personal return, I pay New York State tax on 100% of it, and then New York State gives me a credit for the non-resident taxes that the firm withholds, for all these other states, and my actual New York liability is, maybe 30% of what it would have been on 100% of my compensation. The way that the PTET regime works is, they say that as a resident partner, the firm has to remit PTET based on 100% of my compensation without considering the resident credit. And then they have like a graduated rate that they use for calculating the PTET. So when you kind of look at a firm with 300 partners, you're at the top rate because there's a lot of income when we add 300 people to it, which is a 10.3% rate. But the rate for somebody making, I believe, below $2 million is about 6.85% in New York. So what ends up happening is it's a bit of a windfall for the states. Is the states get a very large payment of the PTET by the partnership, and then when all of the partners file their New York returns, they end up getting very large refunds. So depending on the situation, how many states your partnership is in, you really need to like model all this out and understand how the mechanics of this work, because even though ultimately there is that tax savings there, which is the reason our firm decided to do it, you might be in a position where you have to shell out a bunch of money early and kind of get a refund 6 or 9 months later when people file their personal returns.
Yeah, that's a big cost these days with interest rates, right? For the present value of that money, takes a big drag on it. It's still worth it.
Yeah, it's an interesting point, but if you think about it, so let's say it's interest rates, I don't know, you want to say 7% or some number like that, but we're saving 37%, deduction on it, so it's still worth it. So a few discussion items here. Is PTET limited to state source income? So a lot of states have different answers for residents versus non-resident partners, as I was kind of just explaining in my personal example, where New York for the resident partners would subject 100% of the the taxable income allocated to them to PTET. And for non-resident partners, it would be the apportionable income. So if, let's say, your apportionment is, the partnership has a 15% apportionment factor in New York, the non-resident partners would only pay tax on 15% of their income versus 100% for the resident. As soon as this rule came out, this was like the first question people were asking me: can an investment partnership make a PTET election? The answer to that question is they absolutely can make a PTET election. The states will be happy to take your money. The question is, will you benefit from a federal deduction? When you kind of look at investment partnerships, and like a private equity fund or a hedge fund that doesn't have a trader status, expenses are typically subject to 212, meaning they're not deductible at the individual level. I think people generally got comfortable that it wasn't a 212 expense based on the language in this notice, but then there's unclarity on where on your individual return this deduction goes. Is it an above the line deduction on Schedule E, like it would be for your management company and fully deductible, or does it go someplace on Schedule A and get caught up in AMT and other types of limitations? And the answer to the question is nobody knows. It's a topic that we need guidance on. So I think that, when you look in the industry, I think most people are getting comfortable with filing positions, taking above the line deductions. I've heard of some firms wanting disclosures. So definitely something you should talk to, your tax advisor about, and understand that there's certainly risk associated, with that, position.
That's interesting. I guess I have my own question on that then. On the compliance side, from the CPA side, how much of a percentage of your hedge fund LPs do you find actually making the election?
So typically, the funds themselves are not making the election, because I think, like one is you really wouldn't want to have state tax expense on the fund's books, like reducing returns and things like that. And the administration of dealing with, a fund with hundreds of partners and, multiple states would just be something you don't want to deal with. So typically what we would tell people is, like, if they want PTET, they could form their own investment partnership and invest in the fund through that, and then make their own decisions on PTET elections. Where it does come up would be the GP entities, where do the investment managers want to take PTET on their carried interest allocations? And I would say a meaningful number have opted to do that, understanding the tax risk, that, they see the size of this benefit, and, they want to avail themselves of it. So it's a thing we'll have to see how it evolves.
Thanks.
So, a few other questions: are accrued pass-through entity tax payments deductible? So if you have an accrual basis taxpayer, like normally, they could accrue that tax and then maybe make the payment, after year end. There is some uncertainty, in regard to, how the state works and whether or not, is that accrual fixed, because could you potentially make an election, a decision not to participate in PTET, after year end or something like that. So we typically recommend, if you want to ensure deductibility, that you make the payment prior to year end as a best practice, albeit, if you're going to do it after year end, there's likely a filing position to do so, albeit with some risk. So reducing the risk, best practice, just make your payments prior to year end. Should the PTET deduction be specially allocated? And yes, I think that's essential. Like, if you think about, what I was talking about before, if you look at New York, a resident partner is going to be subject to tax at 100% of the income allocated to them. Non-resident partners are going to be subject to tax at whatever the apportion rate is. And whatever that tax is ultimately flows out to these people as credits on their return. So since, you have people benefiting from these credits, the allocation of that expense needs to follow, how people are benefiting from the credits. So, you definitely would want to especially allocate this deduction, and you might need to, like, revisit your partnership agreement to make sure you're comfortable that the partnership agreement gives you flexibility, to do those allocations. Can a fund make a PTET election? I think we kind of discovered that, where a fund could make a PTET election. In practice, we really don't see that happening. That the PTET elections are, happening either at the GP level, or people are forming family partnerships to make the PTET elections. And can a disregarded entity make a PTET election? And the answer to that question is that they cannot. the PTET election needs to be made by a partnership. So, one thing you can do if you have a disregarded entity is add a minority partner, perhaps a spouse or something, which would then make it a regarded partnership and give you the ability to make a PTET election. There's a few, kind of recent updates I thought that would be helpful to cover. Nothing that I would spend a lot of time on here, but, New York State and New York City. New York had a special rule for S corporations, different from partnerships, where they were saying that, they would only allow PTET on the sourced income or the apportioned income in an S corporation. And the reason for this was because S corporations can't have special allocations. So I think they figured since everything has to be allocated pro rata, we would only do it on the sourced income, so it could be pro rata. They recently came out with a change where if the S corporation has all resident partners, you could elect to pay PTET on the unsourced income as well, which kind of brings it in line with how they're treating partnerships in situations where you have all resident partners. There was an addition of a New York City PTET, which would only be applicable for New York City resident partners at a 3.876% rate. So that's a nice thing if you have New York City resident partners where they can benefit from paying the New York City tax at the partnership level. And just to point out, this is in addition to the UBT tax. So the current UBT tax is still there, and then this would be an additional tax, which would cover people's New York City personal taxes. And then there was some clarification that the add back of the PTET happens at the individual and not the partnership level. There was just some confusion as to how those mechanics work, which resulted in circular calculations and things. So they kind of clarified that to make things more administrable. In Connecticut, there were changes. They're making the PTET optional beginning after 2024, where it was a mandatory, PTET prior to that. And under current law, PTET applies to a standard base or the alternative base. And the difference is the standard base would just be based on portionable income, where the alternative base would be for resident partners. They could elect to pay tax on, well, I want to say 100% of the income, but or the income that's not sourced to other states is the way the Connecticut rule work. So going forward, it's only going to be the alternative base. And it eliminates the options for pass-through entities to file a combined return, where if you had two pass-through entities with similar ownership, they used to let you do PTET on a combined basis. They've eliminated that. Lastly, in New Jersey, so New Jersey has a tax referred to as BAIT, New Jersey tax, and it will be calculated on an income earned by New Jersey resident partners that are individual estates or trust. But I think the change here is that it used to be it would only be on the New Jersey apportionable income. Now they're allowing it on all New Jersey income for resident partners, which kind of puts them in line with New York, and it's going to allow the resident partners to benefit from a larger amount of federal deduction associated with paying more state tax at the pass-through level. So I think that kind of concludes, the presentation on, both the state pass-through entity tax and, the federal self-employment tax issue. Happy to, if there are any other questions in the queue, we're happy to take any questions if people have any.
No, that's great. Thank you both. I think I feel even more nervous about PTET after listening to all that, unfortunately. I'm thinking about what I'm missing. It's so complicated, but yeah, surprisingly, I think we had roughly half the crowd thinking that the PTET conversation was the most important part of it between the two. So there's definitely a lot of interest in it. I'm not alone, I guess. But you guys did great. I appreciate it. We're going to distribute this out with your contacts as well. If anybody wants to do follow-ups, they can certainly do it that way if they didn't have the opportunity to ask a question. And we greatly appreciate your time, and we'll talk again.
Okay, great. Thank you.
Thanks so much, everybody. Take care.
Thank you. Bye-bye.